Okay, so get this right. This ridiculously wealthy executive, like seriously wealthy, you know the type,
Yeah.
and he ends up paying $5,000 for a broken lamp.
What?
Yeah, a broken lamp.
5,000.
Yeah, 5 grand for a broken lamp.
Okay.
Thing was only worth like $500.
Oh, wow.
But he just like, I guess out of spite or whatever,
Yeah.
just shelled out $5,000 for it.
Yeah.
And the kicker is that the same guy ended up totally broke a few years later.
Really?
It's like, how can someone be so good with money, like super successful, and then make such a dumb money decision?
Yeah, that's a good question.
It really highlights what we're talking about today, right?
It does.
Doing well with money, it isn't about how smart you are.
Right.
It's more about your behavior with money.
Yeah, your financial EQ.
Yeah, exactly.
Like how you act around money, how you manage it.
That story really shows that.
Yeah, it throws a wrench in the whole idea that financial success is all about intelligence. We assume that if you understand complex markets, you'll make good financial decisions.
Right.
But that's not always the case.
Definitely not. And changing our behavior, especially around something as emotionally charged as money.
Right.
That is so hard.
It is one of the biggest challenges.
Yeah, even for the smartest people out there.
Absolutely.
How often do we all know what we should be doing with our finances?
Right.
But we just don't do it.
We don't.
It's really a question of, if it's not about being smart,
Right.
then what is it?
Exactly what is driving our financial destinies.
Yeah, like the financial world is obsessed with rules and regulations and complex models.
Oh, yeah, for sure.
But maybe the real key to understanding our money choices lies somewhere else.
Absolutely.
So speaking of interesting financial choices, this is a great story.
Right.
Have you heard of Ronald Redd?
Ronald Redd, no.
He was a philanthropist, investor, janitor, and gas station attendant.
A janitor?
Yeah, a janitor and gas station attendant. But here's the thing. When he passed away, he left behind millions of dollars to charity.
Millions.
Yeah, millions. It's incredible.
That really challenges our assumptions about financial success.
It does.
You wouldn't typically associate a janitor or gas station attendant with that level of wealth.
No, not at all.
It makes you think that maybe formal financial education isn't everything.
Right.
He probably didn't have a fancy degree or spend his days analyzing the markets.
No, I doubt it.
His success must have come from something more fundamental.
And that's exactly what we want to explore today, right?
Yes.
We're not going to give you stock tips or talk about tax loopholes.
Wow.
We're going to unpack the psychology of money.
Yes, the often overlooked emotional and psychological factors that drive our decisions about money.
Right. It's like how the health industry used to rely on anecdotal evidence before they embraced the scientific method.
Right.
The money world still has a ways to go
Yeah, it does.
in understanding human behavior around money.
For sure.
Money is something that impacts everyone, right?
Pretty much.
So understanding its psychology is valuable for everyone.
Absolutely. It's not just about building wealth.
Right.
It's about understanding risk
Yes.
and confidence and even happiness.
Exactly.
It's a powerful way to understand ourselves and others.
And if we need any more proof that the financial world is hard to understand, even for the experts,
Oh, yeah.
just think back to 2008.
The financial crisis.
Yeah.
That was a huge wake-up call.
It was. You had all these brilliant economists and investors, and even they were struggling to figure out what was happening.
They couldn't predict the consequences.
It really shows how important it is to understand the personal and internal factors that shape our financial journeys.
For sure.
So where do we even begin to unravel this web?
Well, a crucial first step is recognizing the influence of our personal history.
Our personal history with money.
Exactly.
It's so obvious, but we often forget that everyone approaches money differently.
Right.
We all have our own background, our own experiences.
And that shapes our perspective on finances.
Yeah. What might seem crazy to you
Yeah.
might make perfect sense to someone else.
Right, because of their own personal history.
And these early experiences, they really stick with us.
They do. They're hard to shake.
Yeah, like someone who grew up in poverty.
Right.
They're going to have a different relationship with risk and reward
For sure.
compared to someone who grew up with financial security.
Yeah, someone who's never experienced true hardship
Right.
might not fully grasp the fear of scarcity.
Right. And that fear can really drive financial decisions.
Absolutely.
And you see this playing out in how different generations view the market.
Oh, yeah.
Someone who came of age during high inflation,
Right.
that's going to shape their views on debt-saving investing.
It's going to have a lasting impact.
Yeah, someone who's only known stable prices might not get it.
Right. They have a completely different frame of reference.
It's like, think about a stockbroker who lived through the Great Depression.
Oh, yeah.
That level of financial devastation.
Right.
It would have shaped their view on market risk forever.
Absolutely.
A tech worker who came of age in the 90s,
Right, during the dot-com bubble.
they'd have a totally different perspective.
Yeah, they might not even be able to comprehend that level of risk.
And similarly, an Australian who's never seen a recession,
Right, 30 years of uninterrupted growth.
their understanding of economic stability is going to be different
Yeah,
than someone in America who's been through multiple downturns.
absolutely.
It's crazy to think about how much our own financial history impacts us.
Yeah,
Our experiences feel so significant,
they do to us.
but they're really just a tiny part of global finance.
A tiny sliver.
But they shape so much of how we see the financial world.
They really do.
And this highlights a limitation of learning about money from books or lectures.
Oh, yeah, for sure.
You can read about the Great Depression,
Right.
analyze the data, understand the severity,
Mm.
but you can't replicate the feeling of fear and uncertainty.
No, you can't replicate that visceral experience.
Spreadsheets can't model the feeling of not knowing how you'll feed your family.
Exactly.
Like Michael Batnick said,
Yeah.
some lessons have to be experienced before they can be understood.
That's a great quote.
We can study all we want,
Yeah.
but until we feel the sting of a financial setback,
Right.
it's hard to truly internalize the lesson.
And there's research to back that up.
There is.
Economists Melmandier and Nagel,
Yeah.
they found that someone's birth cohort and the economic environment when they were young,
Right.
that had a stronger correlation with their risk tolerance
Than their education.
than their education.
Wow. So it's not just about how smart you are or how much you know.
Yeah.
It's about when and where you grew up.
Exactly.
That's fascinating.
It is. It really highlights the impact of our environment.
It reminds me of Bill Gross, the bond investor.
Yeah.
He admitted that his success was largely due to the decline in interest rates.
Right. He was in the right place at the right time.
It was fortunate timing.
Yeah, and a specific economic backdrop.
Bonds were a great investment for him.
They were.
But his father's generation, who lived through high inflation,
Right.
they might have seen bonds as risky.
As a way to lose money.
Yeah. Different economic realities lead to different perceptions.
Absolutely.
And the differences in financial realities can be huge,
They can.
even within the same country.
Right.
Think about the unemployment rates during the 2008 recession.
Oh, yeah.
The national average was around 10%.
Yeah?
But for young African-American men without a high school diploma,
Right.
the unemployment rate was 50%.
50%.
And for Caucasian women over 45 with a college degree,
Yeah.
it was closer to 4%.
That's a massive difference.
It is two totally different worlds.
Yeah, it's important to remember that everyone's situation is unique.
So someone's financial decisions might seem illogical to us,
Yeah,
but they make sense to that person.
they do at that moment in time.
They're operating based on their own experiences
Right.
and their own narrative about money.
Yeah, their own personal story about how money works.
Like, look at lottery tickets.
Yeah.
Lower income households spend a lot on lottery tickets,
They do?
more than wealthier groups.
Yeah, it seems irrational.
It does, because they often don't have much financial margin for error.
Right.
But if we think about it from their perspective,
Okay.
it might make more sense.
Yeah, maybe.
They might feel like it's their only chance
Their only hope.
to achieve financial security.
Yeah.
It's like buying a dream.
A chance at a better life.
Even if the odds are slim.
It's understandable why they would do that.
So instead of judging their decisions,
Yeah.
we should try to understand why they're making them.
That's key for us to understand the influence of personal history and perspective.
Exactly.
It's not always about right or wrong.
Right.
It's about understanding the underlying motivations.
And that brings us to the roles of luck and risk,
Yes.
which are so hard to measure and acknowledge.
They really are.
Right.
We often underestimate the role of chance.
We do.
Like take Bill Gates.
Right.
He's brilliant and hardworking.
Yeah, no doubt.
But what if there was someone just as talented and driven
Right.
who just wasn't in the right place at the right time?
Yeah.
Let's call him Ken Evans.
Kent Evans. Yeah.
Ken Evans might not have achieved the same level of success.
Right.
Not because he wasn't good enough,
Yeah.
but because of luck.
Because of circumstances.
Exactly.
So maybe we need to rethink how we judge financial success,
Yeah,
both in others and in ourselves.
for sure.
If luck and risk are factors,
Right.
then outcomes aren't always a reflection of skill.
It's not always about being good or bad at money.
It's more nuanced than that.
Yeah.
The economist Robert Shiller,
Yeah.
he asked a great question.
What was it?
What can't we know about investing?
That's a good one.
It's a reminder that the future is unpredictable.
It is, no matter how smart we think we are.
And we're biased against attributing success to luck.
We are.
If someone...
It can.
But if we acknowledge the role of luck in our own success,
Yeah.
it can feel like we didn't earn it.
Like we didn't deserve it.
It's a tricky balance.
It is.
And it's hard to separate a bad decision with a good outcome
Right.
from a good decision with a bad outcome.
Yeah, because of risk.
We want simple stories,
We do.
but luck and risk make things messy.
They make things complicated.
So those how-to lessons from success stories,
Yeah.
they can be misleading.
They can.
We want to believe there's a formula,
Right.
but luck plays a role.
It does, especially in extreme cases.
Like Warren Buffett,
Yeah.
he's obviously skilled,
He is.
but luck has been on his side too.
Absolutely.
It's like that story about Cornelius Vanderbilt.
Oh, yeah.
When he was told his business practices were illegal,
Right.
he said, "Ain't I got the power?"
He basically ignored the rules.
And he got away with it.
He did for a while.
But that same attitude can lead to disaster.
It can if luck runs out.
The line between boldness and recklessness
Yeah.
is blurry.
It is, especially when we ignore risk.
Like Benjamin Graham.
Yeah, the father of value investing.
He invested heavily in Geico,
He did.
which went against his own rules.
His own diversification rules.
Was it genius or just luck?
It's hard to say,
It's hard to know.
even for someone like Graham.
So instead of trying to copy the outliers,
Yeah,
we should focus on broader patterns.
of success and failure.
Yeah, the more widespread a pattern is,
Right.
the more likely it is to be reliable.
And applicable to our own lives.
Bill Gates said success is a lousy teacher.
He did.
It makes smart people think they can't lose.
It does. It breeds overconfidence.
So when things are going well,
Right.
we need to stay humble,
We do.
acknowledge the role of luck.
And remember that luck can turn into risk.
Things are never as good or as bad as they seem.
That's a good point to remember.
So financial humility is key.
Yeah.
Recognize luck and risk.
Mm.
And remember that outcomes aren't always a reflection of skill. Now let's talk about the paradox of enough.
Okay.
When do we have enough money?
That's a tough question.
There's a story about Kurt Vonnegut and Joseph Heller.
Oh, yeah. I love that story.
They were at a party hosted by a billionaire.
A hedge fund manager.
Yeah, and Vonnegut said that the host probably made more in a day
Right.
than Heller made from Catch-22.
Yeah.
And Heller said, yes, but I have something he'll never have.
Enough.
Enough.
That's such a profound statement.
It highlights the subjective nature of wealth.
Yeah.
It's not just about the numbers.
It's about feeling content.
Contrast that with Rajat Gupta.
The former CEO of McKinsey.
Yeah, he had it all.
He did Success Will Philanthropy.
Board memberships.
He was at the top of his game.
He had a net worth of $100 million.
100 million.
An unimaginable amount for most of us.
It is.
But he was convicted of insider trading.
He risked everything.
For
Real.
war, it makes you wonder what drives people to take such risks.
Yeah, when they already have more than enough.
And it's not just him.
No.
Look at long-term capital management.
The hedge fund.
Yeah, it was run by brilliant people.
Some of the best minds in finance.
Many of them were already incredibly wealthy.
They were.
But they took on too much risk.
They did, and they lost everything.
Warren Buffett said it best.
What did he say?
To make money they didn't have and didn't need,
Right.
they risked what they did have and did need.
And that's foolish.
It's so simple, but so true.
It is.
There's no reason to risk what you need for what you don't need.
We should all remember that.
Now, most of us won't reach Gupta's level of wealth,
Probably not.
but many of us will reach a point where we have enough.
Enough to cover our needs and wants.
It challenges recognizing that point.
And stopping the goalposts from moving.
Yeah, we always want more.
It's human nature.
We compare ourselves to others.
We do.
And we feel like we need to keep up.
Even when we have plenty.
So true enough is about realizing when you have it.
Yes, and avoiding unnecessary risks.
We should never risk our reputation,
Right.
our freedom, our family, our friends, our love, our happiness.
Those are the things that truly matter.
And building enough often doesn't require big risks.
It doesn't. It's often about simple actions.
Over time.
Yes, consistency is key.
Which brings us to long-term thinking and compounding.
Yes, the power of time.
It's like ice ages.
Ice ages.
Yeah, small changes over long periods lead to huge results.
It's like the tilt of the Earth's axis.
Exactly, it causes ice ages.
Amazing.
It's not the amount of snow.
Right.
It's the fact that it persists.
It accumulates over time.
And it's the same with money.
Compounding allows small beginnings to grow exponentially.
It's counterintuitive.
We underestimate its power.
Look at Warren Buffett again.
Okay.
His wealth isn't just from high returns, it's from investing consistently since childhood.
Over a very long period.
Imagine if he'd started 10 years later.
Yeah.
His net worth would be way lower.
It would be a fraction of what it is today.
The power of time is incredible.
It really is.
Now compare Buffett to Jim Simons.
The founder of Renaissance Technologies.
Yeah, Simons has higher average returns.
He does.
But he started later.
Much later.
So Buffett is still wealthier.
That's because of compounding.
Imagine if Simons had started when Buffett did.
Wow. His wealth would be astronomical.
It's hard to wrap our minds around compounding.
It is. We're wired for linear thinking.
Arithmetic growth.
Adding a fixed amount over time.
But compounding is geometric growth.
Growth on top of growth.
It's like hard drive storage capacity.
Okay.
It's grown exponentially over the decades.
From megabytes to terabytes?
Even Bill Gates underestimated it.
He
He
did.
didn't think we'd need that much storage.
Yeah, it's hard to predict exponential growth.
Now think about Jesse Livermore and Abraham Shermansky.
The investors from the 1929 crash.
Livermore got rich.
Yeah.
Shermansky was ruined.
They both experienced the same event?
But with different outcomes.
Right.
They were both good at getting wealthy,
They were?
but not at staying wealthy.
That's the key.
Long-term success is about survival.
It's about weathering the storms.
So many companies lose most of their value eventually.
They do.
They don't survive.
Survival is key.
Michael Moritz from Sequoia Capital.
Yeah.
He said their fear of going out of business is what drives their success.
It keeps them focused on the long term.
Compounding takes time.
It does. It's like planting an oak tree,
You need years of uninterrupted growth.
and you need to avoid those big losses.
Cash might have a low return,
Yeah,
but it can prevent you from selling at the worst time.
exactly. It can help you survive a downturn.
Good returns sustained over time will
Yeah.
always beat chasing high returns and risking everything.
It's the tortoise and the hare.
Slow and steady wins the race.
Absolutely.
So listeners, think about the long term
Yeah.
and the power of compound.
Your future self will thank you.
And on that note,
Yeah.
here's a final thought for you.
Okay.
We've talked about how our experiences and psychology shape our financial lives
We have.
and how powerful long-term thinking is.
It's incredibly powerful.
So what's one small change you can make today
Yeah.
to align your financial decisions with your future goals?
That's the question.
What can you do differently starting now?
To create a better financial future.
Because your future self might have different priorities
Right.
than you do today.
It's something to think about.
It is.
Thanks for listening.
Thanks for being here.